The guru can be profitable even when his strategy isn't. The first thing we need to know is where the first $1 comes from. The business can make money from a course or a signal room. The business can also make money from video ads or a broker link. All 4 payments are business income. None of this income comes from the trading result. So keep 2 records. One records business income. The second records trading results. A winning screenshot shows one winning trade. A car on camera only shows a car. Creator income can't establish strategy profit. If you want to know whether a strategy made money, you have to look at the trade record. You need the wins and losses. You need the trading costs. You need to know how much risk was taken. A course payment cannot answer any of those questions. A strategy that reliably made money raises a simple question. Why sell the strategy? I'm not selling a strategy. I want to show how an idea earns the right to be tested. Without a written test, you're taking the other side of traders who did the work. You become the market for the better prepared trader. Let's look at the order. Most strategy videos show a green curve first. You see a winning trade, and then you hear a story about why the trade worked. We're going to start before the result. First, write down what happened. Next, write down other reasons for the move, including chance. Pick one explanation and give the idea a clear way to fail. Then, write every trading rule. Choose the measurements before we look at the answer. Put the rejection line on the page before the result appears. The full plan is the intake record. We don't open a recorded run until the full plan is complete. A magic indicator gives you excitement. An honest test gives a bad idea somewhere to die. Episode 1 gives every weak idea a clear place to stop. Start with something you can point to on a chart. Let's use a simple range example. Price trades inside a quiet range. Then price closes outside the range and keeps moving for several bars. Write down the market and time frame. Mark the start of the range and the move outside. An observation only describes what happened. An observation does not claim a cause. An indicator name can't replace the price move. Don't say buyers took control unless the evidence measures buyer activity. The range example only shows the method. At this point, we have a question. Does price continue far enough to cover normal trading costs? We don't have a strategy yet, so there is no reason to risk money. Now let's look at why the move happened. One answer may be new orders after a quiet range. A news release may be the reason. Time of day may be the reason. Chance has to stay on the page. All 4 explanations can fit the same chart after the move. Anyone can make a story fit after the fact. A fair test is harder. Write down what each explanation predicts, then write down the evidence that would count against each answer. If chance can explain the same result, the favorite story has more work to do. An explanation with no losing answer isn't ready for research. If you only write the reason you like, you are going to find support on almost any chart. You need to write down the other reasons as well. Then you can ask what each reason would look like before the next move. The extra reasons keep the favorite story from taking over. We don't want a story that can win every answer. We need a result that can end the research. Let's take a look at one explanation and write a falsifiable hypothesis. Falsifiable means a clear result can show the explanation failed. Use the range example. The condition is a narrow recent range. The event is a close outside the range. The prediction says price continues for several bars and covers normal trading costs. Then write the losing answer. Maybe the move fails too often. Maybe average loss is too large. Maybe commission and slippage take away the small advantage. We can't measure market intention in this example. We can measure prices and trades. We can measure costs and the result after costs. A useful hypothesis connects the setup with one measurable result. The same page names the answer that rejects the candidate. A clever story doesn't help unless the numbers can make a stop. A hypothesis still isn't a strategy. Candidate means one complete version ready for a written test. A back test is a replay of the written rules over old prices. Let's start with the market and time frame. Write the entry rule and fill model. Write the exit rule and position size. Add stop loss and profit target. Set trading hours. Add commission and slippage. Write down maximum risk and the data window. Another person should be able to place the same trades from the page. If the trades don't match, the rules need more work. If you want to test a trading idea, you have to write down what you mean. You need to know the market and the time frame. You need to know the entry and the exit. You also need to know the cost and the risk. Without those numbers, two people can get different trades from the same idea. Don't fill a gap after the result is known. Write down the missing choice and count the new page as another candidate. A few small choices can create a lot of versions. Give range length 2 settings. Do the same for entry, exit, stop, and trading session. 5 choices, with 2 settings each, produce 32 candidates. Every combination counts as a separate version. Before we look at a result, we need to write down the plan. Start with the observation and other explanations. Add the hypothesis and complete trading rules. Write down the market, time frame, and data window. This kind of record has a name: pre-registration. Pre-registration means the plan cannot change after we see the numbers. If you want to know the answer, you have to keep the same plan from the first trade to the last trade. If you change the plan after the answer, you have a new test. You don't have a second look at the old test. Before you look at the result, you need to know what answer would make you stop. You also need to know what you are going to measure. If you wait until after the test, you can move the line to keep the strategy alive. The whole reason for pre-registration is to stop that move. Now let's look at how the result will be scored. Gate means a pass or stop decision inside the pipeline. A threshold is the number a measurement must cross. Trade count tells you how many trades finished. Trades per month divides that count by the months in the test. Win rate means how often the strategy won. Win rate doesn't tell you profitability by itself. Gross wins are all winning trade amounts added together. Gross losses are all losing trade amounts added together. Profit factor is the ratio of gross wins to gross losses. Add every win. Add every loss as a positive number. Divide wins by losses. Net profit adds all winning and losing trades after included costs. Commission is the fee paid when an order trades. Slippage is the extra price cost between the reference price and the modeled fill. Max drawdown is the deepest fall from a peak in the running result. Return to drawdown puts the recorded return beside the fall. No single measurement gives the whole answer. You can't move the threshold after the result appears. Keep every old version when a rule or threshold changes. Now we're ready to read the real pipeline runs. In this case, we have 3 separate runs saved from the intake stage. The first block of old prices has a name: the in-sample window. This price window is where each strategy was built and screened. Let's start with Dow Futures. The data starts on June 6, 2010 and ends on February 25, 2018. The run tested 1,335 candidates. Next comes S&P 500 Futures. The data starts on July 6, 2003 and ends on June 8, 2013. The run tested 2,004 candidates. Then we have Euro USD. The data starts on January 2022. The run tested 2,051 candidates. Across the whole group, 5,390 candidates entered the first screen. The saved records use real market data. 2 runs use futures markets. 1 run uses foreign exchange. The 3 saved runs are research results. The saved receipts do not show historical pre-registration for all 3 runs. Episode 01 teaches the standard to use before a new run. We can say what happened in the listed price windows. We can't promise live performance or a future result. Now let's look at the first result. In Dow Futures, 184 of 1,335 candidates moved to the next test. In S&P 500 Futures, 0 of 2,004 moved on. In Euro USD, 0 of 2,501 moved on. That leaves 5,206 candidates stopped at the first screen. Let's take a look at the Dow failure counts. Return to drawdown failed for 1,122 candidates. Profit factor failed for 1,065. Trading activity failed for 150. One candidate can fail more than one threshold. The Dow file has 1,151 unique failed candidates. Add the 3 reason counts and some strategies get counted twice. So keep the 1,151 unique failures separate from the reason counts. The answer covers the exact strategies and decision lines used in the listed price windows. We can say what happened in the 3 recorded runs. We can't turn the answer into a claim about every strategy in every market. Now let's take a look at one Dow strategy and walk through the numbers. Profit factor is 1.20870. Return to drawdown is 4.93317Z. The saved file contains 533 trades. The total includes 210 wins and 343 losses. If you want to use a backtest, you need to know how the result was made. The strategy passed because all measurements worked together under the written decision lines. Win count by itself doesn't answer the question. A pass also cannot establish future performance. The first screen leaves 184 strategies waiting for the next test. Why keep the full search count? When you run a big search, random luck gets more chances to make an attractive curve. Sales copy wants a yes. Honest research accepts a no. The useful result includes 144 passes and 5,206 weak versions, with a written reason to stop before real money. Next, the 184 Dow strategies move into another test. The trading rules don't change. The first price window stays closed, and we open a later block of prices. The later block is the out-of-sample test. The new question is simple. Did the strategy keep working on prices that played no part in the first decision? A failed result stays failed. Any strategy still above the line faces more work. If you have a result that still looks good, you want to know where the result can break. A new price window can break the result. A different time of day can break the result. Higher trading costs can break the result. Small changes in settings can break the result. Each test gives us a different question. Later episodes change the clock and add real trading costs. Then we move the settings and change the order of trades. The last tests measure whether the result keeps working through time. No later episode rescues an earlier failure. Each new test removes one more excuse. Weak ideas get a clear stopping point. Every surviving strategy meets a new reason to fail. If you want to try the same process on a new idea, start with a one-page intake sheet. Write down the market observation. Add at least 2 explanations and keep chance on the page. Use one explanation to write a falsifiable hypothesis. Then write the full strategy. Name the market and time frame. Write the entry rule and fill model. Add position size and the exit rule. Write down the stop, profit target, and trading hours. Add commission and slippage. Record maximum risk and the data window. Choose the measurements and thresholds before opening the result. Set the rejection line. You can't open the in-sample result until the full page is frozen. Keep every failed version. Count every version in the search. In the 3 recorded runs, 5,390 candidates entered and 184 earned the next test. Episode 2 opens a later price block. Same rules. New evidence, no rescue after the answer. A green line earns the next question, and $0 of blind trust.